Chairman of Lynch Federation, Peter Lynch is an investor, mutual fund manager, and a philanthropist. He managed Magellan Fund at Fidelity Investments for around 13 years and delivered an average annual return of a decent 29.2%. Well, let's take a look at some of his market investing tips. Now, one tip of his is to take a long-term approach. To make serious money and outperform the markets, an investor really needs to have a long-term view. To get the benefit of compounding, an investor needs to give time to his investment. Having a long-term view also helps an investor to withstand the short-term market volatility and price swings. These short-term movements are the biggest reasons an investor exits his position prematurely. To identify a multi-bagger stock, an investor needs to pick it up in an early phase, preferably when it's a small cap company. It's a no-brainer that the lower the market cap of the company, the higher its growth potential is. In other words, it's easier to deliver 100% growth by a $100 million market cap company than a $10 billion company. Now, these kinds of stocks should be spotted before the analyst coverage, as it's always better to get in before everybody knows about it. Peter Lynch often starts looking for a new investment opportunity by filtering the companies based on their business models. He emphasizes the importance of individual investor approach instead of a fund manager's approach. Now, the difference between the two is that an investor following an individual approach can spot suitable investments from his day-to-day life, whilst a fund manager does it by going through numerous financial statements, data crunching, sophisticated analytics, for example. He says if an investor cannot explain to a 10-year-old child in 2 minutes why he owns a stock, he should not be owning it. Now, Peter Lynch always advocates to do your homework. First-hand interpretations and anecdotal evidence are a great start, but all these great ideas need to be followed up with smart research. When following up on the initial spark of a great idea, Lynch highlights several basic values that he anticipated to be met for any stock worth buying. The price-earnings to growth ratio of valuation to earnings growth rate should be looked at to see how much expectation is built into the stock. You want to seek out companies with strong earnings growth and reasonable valuations. A strong grower with a PEG ratio of 2 or more has that earnings growth already built into the stock price, leaving little room for error. Favor companies with solid cash positions and below average debt to equity ratios. Solid cash flows and careful management of assets give the company options in all types of market environments. And as Peter Lynch rightly says, the real key to making money in stocks is not to get scared out of them. So what do you think? Do you like Peter Lynch's tips? Leave a comment on them at the end of this video. You can also share this video with a friend, and you can subscribe to our YouTube channel. You can also press the bell icon to get notifications for our latest videos. I'm Rachel for Kalkine Media.